You had 3 trades open, and honestly, you felt pretty smart about it. Long Euro USD, short USD CHF, long GBP USD. 3 different charts, 3 different setups, risk spread nicely across the screen. Then $1 headline landed, and all 3 went red inside the same minute. That wasn't bad luck, and it wasn't 3 trades going wrong. It was 1 trade going wrong, 3 times. So today, we fix something almost nobody explains to beginners. Why so many pairs move together in the first place? Which currency is quietly driving your entire screen? How correlated positions multiply the risk you thought you were spreading out? And just as important, when these relationships break, and why treating one as a promise is exactly how people get hurt. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. Let's start with why this happens at all, because it isn't mysterious. Go back to the second video. A pair is never one thing. It's 2 currencies compared against each other. So the moment the same currency shows up on 2 of your charts, those 2 charts share an engine. They aren't independent instruments. They're 2 different ways of saying the same thing about the same money. Take the classic example, Euro USD and GBP USD. Look at where the dollar sits, on the right-hand side of both. So when the dollar strengthens across the board, both of those pairs get pushed down at the same moment, by the same force, for the same reason. There's nothing secret about it. It's arithmetic. The shared currency does the work. But it's never a perfect copy, and that's the interesting part. The left sides are different. The euro has the European Central Bank and German data behind it. The pound has the Bank of England and its own inflation story. So those 2 charts rhyme most of the time, and then separate the moment Europe and Britain start telling different stories about their own money. Correlation comes in 2 flavors. Positive means they move the same way. Negative means they move opposite. And the sign usually comes down to something as simple as which side the shared currency is standing on. Remember USD/CHF from the 6th video? It looks almost like a mirror image of Euro USD. That's because the dollars swapped sides. Same driver, flipped chart. Which sets up a trap that catches confident beginners. Buying Euro USD and buying USD CHF feels like 2 ideas. It's actually 1 idea and its opposite. You're short dollars on one screen and long dollars on the other, mostly canceling yourself out, and paying 2 spreads for the privilege of holding almost nothing. 2 positions? No position. You'll also see correlation written as a number between +1 and -1. +1 means they've been moving in lockstep. -1 means perfect mirror, and 0 means no visible relationship at all. Real pairs live somewhere in between and wander constantly. Treat that number as a thermometer reading, not a rule. It describes what has been happening, nothing more. Now let's name the families, because 3 of them explain most of your screen. The first is the dollar family, and it's the biggest by a mile. The dollar sits on one side of roughly 89% of all Forex trades. So on a day when the dollar has a strong opinion, almost everything you have open is a dollar trade, whether you chose it that way or not. The second family is the yen. When the yen is the one leading, a Bank of Japan surprise or a wave of fear rolling through the market, USD JPY, Euro JPY, GBP JPY, and AUD JPY all start traveling together. The yen is driving. The currency on the other side is just a passenger along for the ride. 4 charts, 1 story. And that hands you a genuinely useful diagnostic. Look across your watch list and ask which currency appears in everything that's moving. If every yen pair is running while the dollar pairs sit still, the yen is driving. If everything with a dollar in it moves at once, it's the dollar. The currency they have in common is always the engine. The third family is risk appetite, and you've already met it. The Aussie and the Kiwi are near twins. Same commodity story, same exposure to China, same behavior when the world feels brave. So odd USD/USD and NZD/USD track each other closely. And odd JPY, with a risk currency on one side and a safe haven on the other, becomes the market's fear thermometer. This doesn't stop at currency pairs either. Gold and the dollar tend to lean against each other. Oil and the Canadian dollar move together often enough that USD/CAD reacts to a crude inventory number. So if you're long gold on one tab and short the dollar on another, you may be holding the same view twice without ever realizing you did it. Which brings us to the part that actually costs money. Go back to those three positions from the start. Long Euro USD, short USD CHF, long GBP USD. Line them up by currency, and it isn't three trades. It's one trade, short the dollar, at triple size. It looks like diversification because there are three tabs open. It behaves like concentration. And your account only ever feels the second one. If you risk 1% on each, and all three move almost identically, you have not risked 1% three separate times. You've risked close to 3% once on a single idea. The market never reads the names of your trades. It only sees the exposure sitting underneath them. There's a human cost too, and it's bigger than people expect. 3 losses arriving in the same minute doesn't feel like one idea being wrong. It feels like everything failing at once. That's how a manageable loss turns into a revenge trade. How you carry that is trading psychology's territory, but the way you avoid it lives right here. Don't stack the same bet. It also quietly destroys the protection you thought your stops were giving you. Last video, we watched one American number reprice everything the dollar touches. Well, a correlated stack hands that single number 3 of your positions at the same instant. 1 release, 1 direction, 3 stops. That isn't a run of bad luck. That's a structure you built yourself. So here's the first fix, and it takes about 30 seconds. Stop counting charts and start counting currencies. Write your open trades out as exposure. Long Euro USD, long GBP USD, short USD CHF becomes short dollar, short dollar, short dollar. Written down that way, nobody on earth would call it diversified. The list makes the argument for you. Second fix, one idea, one expression. If your view is that the dollar looks weak this week, pick the single cleanest pair to say it in, the tightest spread, in the session where it's most active, and say it once. 3 pairs don't make the idea any more right. They only make being wrong 3 times more expensive. Third fix, for when you genuinely do want 2 positions in the same family, shrink them. 2 correlated trades at half size carry roughly the risk of 1 at full size, which is probably the risk you meant to take in the first place. The number of positions was never the problem. The total exposure behind them is. Now the honest part, because correlation gets sold as if it were a law, and it isn't. It's a description of the recent past. 2 pairs travel together, while some shared driver is the loudest thing in the room, and they stop the moment a local driver takes over. The relationship is a market condition, not a guarantee, much like the sessions themselves. And you can watch it break in real time. A Bank of England decision splits GBP USD away from Euro USD for the rest of the day, because suddenly the pound has a story of its own. A Chinese growth number pulls the Aussie away from everything else. The shared engine hasn't disappeared, it's just been outshouted by something closer to home. It also depends completely on the time frame you're looking at. 2 pairs can be almost glued together inside a single London session, and then look nearly unrelated over 3 months, because different drivers dominate at different scales. So a correlation figure you read somewhere is meaningless until you know what period it was measured over. And the most dangerous version of all is leaning on a negative correlation as a hedge. I'm long Euro USD and long USD CHF, so I'm covered. You're covered exactly as long as that mirror holds, and when it loosens, and it will, both sides can lose together. A hedge that's allowed to quit without telling you was never really a hedge. Checking any of this needs no special tool, by the way. Coefficient tables exist, and they're fine, but you can put the two charts side by side on the same time frame and simply look at the shapes. If the last few days rhyme, they're correlated right now. That's all the precision you need before deciding whether to open the second position. And one last thing, because correlation isn't only a warning, it's information. If the dollar is sliding and Euro USD is climbing nicely, while GBP USD refuses to follow, the relationship didn't fail, it just told you something. The pound is the weak one today. That gap between two pairs that normally agree is your first glimpse of relative currency strength, and that's exactly where this course goes next chapter. So, homework, and it's a quick one. For 1 week, before you place anything, write your open positions out as currency exposure instead of pair names. Long euro, short dollar, long yen, and so on. Then count how many times the same currency shows up on that list. Most people find one currency written 3 times and had been calling it a portfolio. Seeing it in your own handwriting fixes it faster than any rule I could give you. So, why do so many pairs move together? Because a pair is 2 currencies, and the moment the same currency turns up on several of your charts, those charts share an engine and stop being independent. Correlation doesn't create your risk. It reveals that you were taking the same risk more than once. So count currencies, not charts, and never treat the relationship as a promise. And if the dollar is the engine underneath most of your screen, there's an obvious next question. Is there one chart that just tells you what the dollar itself is doing, so you don't have to read it out of 6 pairs at once and hope you got it right? There is. It's called the dollar index. And in the next video, we'll use it as a single filter for your dollar bias before you look at any pair at all. I'll see you there, trader. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the ComLucro trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts. It's about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.